Ask Carlo. Private equity simplified.
15th July 1997, 8:45 in the morning, Miami Beach, Ocean Drive. Gianni Versace, the most famous fashion designer on earth, walks back from a news cafe, a magazine under his arm. On the steps to his own mansion, Casa Casuarina, a man fires 2 shots. Versace falls. He is pronounced dead within an hour. The killer, a serial murderer named Andrew Cunanan, would take his own life 8 days later on a houseboat a few miles away. But the real damage above Versace's death was not only to a man, it was to a company. Without its founder, the house of Versace began to unravel. Revenue fell from nearly 1 billion euros in the late 1990s to less than half of that by 2009. The family held it. Donatella, Gianni's younger sister, took the creative reins. Santo, the elder brother, ran the business. For 17 years, they kept the Medusa alive, but barely. Then in February 2014, a New York fund called Blackstone, the world's largest alternative asset manager, wrote a check for 210 million euros for a 20% stake. 4.5 years later, the entire company was sold for 1.83 billion euros. The Medusa had more than doubled in value. This is a story of how private equity actually creates value, not with spreadsheets alone, but with stores, strategy, and a new chief executive. Welcome to the Versace Playbook. This is Ask Carlo, Private Equity Simplified. I'm Carlo Schneider. Over 11 episodes, we have explored buyouts, venture, growth equity, secondary buyouts, infrastructure, private credit, premiumization, and retail access. We met Montclair and Formula One, Spotify and Revolut, the Channel Tunnel and Oman Resorts, Jimmy Choo, Birkenstock, and Inter Milan. Today is the final episode of Module 1, the foundations. And the question we close with is the most fundamental of all. Once a private equity fund actually owns a business, what does it do? How does it take something worth 1 billion and turn it to something worth 2 billion euro? The textbook answer is value creation. The real answer is 5 specific things, and Versace is the clearest example I know. Quick disclaimer, everything I share is educational only. This is not investment advice. I am not recommending Blackstone. I am not recommending any fund. And I'm not recommending you to buy a Medusa handbag as an investment. I'm telling a story and explaining a mechanism. If you're new, subscribe. Every Tuesday, one real deal, one clear lesson. To understand what Blackstone did, you first need to understand what they walked into. When Gianni Versace was alive, the house was a supernova. He dressed Princess Diana, Elton John, and every supermodel of the 1990s. The Medusa logo was a symbol of power and provocation. Revenue was approaching 1 billion euros. The company was privately held by 3 siblings. Gianni, who owned 50%, Santo, who held 30%, and Donatella, who held 20%. After the murder, Donatella became creative director. She was 42 years old, grieving, and had never run a collection on her own. By her own admission, she was not prepared. The early collections were uneven, critics were divided, sales drifted. Santo ran the numbers, but the numbers were not kind. By 2004, the company had cut staff. By 2009, revenue had halved. The family considered outside investors several times, but each conversation stalled. Donatella stabilized the creative side gradually, but the business side needed a different kind of expertise. By 2013, Versace was a strange thing in luxury, a globally recognized brand with a Medusa on every magazine cover, but a company punching well below its weight. Revenue was roughly 600 million euros. Profitability was thin. The store network was outdated. E-commerce barely existed. And every competitor, from Gucci to Prada to Louis Vuitton, was outspending them on retail, digital, and expansion. That is the moment Blackstone entered. In February 2014, Blackstone Group, founded in New York in 1985 by Steven Schwarzman and Peter Peterson, and today the world's largest alternative asset manager with over $1 trillion in assets under management, acquired a 20% stake in Gianni Versace SPA for 210 million euros. That implied a valuation of roughly 1 billion euros for the whole company. Now, 20% is not a majority. Blackstone did not control Versace the way a traditional leverage buyout would. The Versace family retained 80%, but 20% with the right governance provisions is enough to reshape a company, and that is exactly what happened. What followed was a textbook exercise in what private equity professionals call value creation. And it has 5 levers. Lever 1, retail expansion. When Blackstone arrived, Versace operated roughly 137 directly owned stores worldwide. The plan was to reach 200, then 300. New flagships opened in major cities. The mix shifted away from wholesale, where margins are thinner and brand control is weaker, towards directly operated retail, where the company controls pricing, presentation, and the customer relationship. By 2016, the store count had passed those 200. Lever 2, revenue growth. Between 2014 and 2017, Versace's revenues climbed from roughly 600 million euros to 686 million euros, a rise of around 14%. Most importantly, in the final full year before the sale, revenue grew 18% in a single year. That kind of acceleration matters enormously to a buyer because it signals momentum, not just size. Lever 3, digital and e-commerce. In 2014, Versace's online presence was almost decorative. Blackstone pushed the company to build a proper e-commerce platform and invest in digital marketing aimed at younger, digitally native customers. E-commerce revenue grew over 30% in 2016 alone. For a heritage house that had relied on department stores and physical boutiques for decades, this was a structural change. Lever 4, management professionalization. This is the lever most people outside finance do not see, and it is often the most important. In May 2016, Blackstone helped install Jonathan Akeroyd as chief executive, replacing Gian Giacomo Ferraris. Akeroyd had spent 12 years running Alexander McQueen, another high-end fashion house where he had delivered consistent growth. He brought operational rigor, a clear expansion plan, and a credibility with wholesale partners and press that the company needed. Donatella remained creative director. The partnership between professional manager and a family creative is the classic private equity formula in luxury. Lever 5, exit preparation. From the moment Blackstone invested, the clock was ticking towards a sale or an IPO. Every decision, from store openings to management hires to financial reporting standards, was designed to make Versace attractive to a buyer or to public market investors. The company reported a swing from a 7.4 million euros loss in 2016 to 15 million euros profit in 2017. That was not just good business, it was a signal the house was clean, growing, and ready. In 2018, the American fashion group Michael Kors, which would soon rename itself Capri Holdings, announced the acquisition of Versace for 1.83 billion euros, roughly $2.12 billion. Remember the entry valuation, 1 billion euros. In 4.5 years, the enterprise value had nearly doubled. Blackstone's 20% stake, bought for 210 million euros, was now worth a share of 1.83 billion euros. The family holding 80% received the lion's share. But the important lesson is not the profit, it is the method. Nothing about Versace's product changed. Donatella's design aesthetic was the same. The Medusa logo was the same. The brand DNA was the same. What changed was the machine around it. More stores, better management, a digital platform, stronger financials, and a clear path to future growth. Blackstone did not redesign the dress. They rebuilt the company that sells the dress. That is value creation, and it separates a private equity investment from a financial bet. A bet says, I buy this, I hope the price goes up, I sell. Value creation says, I buy this, I build something specific, and when I sell, the business is objectively better than when I found it. Let's decode today's essential term, value creation. In private equity, value creation refers to the deliberate actions a fund takes to increase the worth of a company between entry and exit. It is not market luck, it is not rising tide, it is engineering. There are broadly three ways a private equity fund creates value. The first is revenue growth, selling more products, entering new markets, acquiring competitors. The second is margin improvement, cutting costs, improving efficiency, renegotiating supplier contracts. The third is multiple expansion, making the company more attractive to the next buyer by improving its growth profile, its governance, or its market position, so the buyer is willing to pay a higher multiple of earnings. In Versace's case, all three were at work. Revenue growth from 600 million to 686 million euros. Margins improved from a loss to a profit, and the multiple the buyer was willing to pay rose because the company was visibly on an upward trajectory. Think of it this way: you buy a flat in a good location, but in poor condition. You renovate the kitchen, add a bathroom, fix the roof, and landscape the garden. When you sell, the price reflects not just the neighborhood, but everything you build. That is value creation. Private equity does the same, except the flat is a company and the renovation is strategy, capital, and management. This week's question comes from Luisa in Zurich, who asks, Carlo, if value creation is so straightforward, why doesn't every private equity deal succeed? Grüezi, Luisa. That's an excellent question because it is not straightforward at all. It only looks straightforward in hindsight. First, not every company can be improved. Some brands are in structural decline, some markets are shrinking, some management teams resist change. A fund can have the right playbook, but the wrong patient. Second, leverage. Most buyouts use significant debt. If revenue growth stalls and interest payments keep rising, the math can turn ugly quickly. Value creation must outrun the cost of capital. In Versace's case, Blackstone only took 20%, which meant less leverage and less pressure, but also less control. Third, timing. Blackstone invested in 2014 and exited in 2018. Luxury markets were buoyant. If the global economy had turned, if Chinese demand for European luxury had softened, the exit valuation could have been lower. The honest answer is that roughly 1 in 4 private equity deals underperforms, according to research by McKinsey, the management consultancy. Value creation is a discipline, not a guarantee. The best funds succeed more often not because they are luckier, but because they have better operating partners, better playbooks, and more discipline in choosing which companies to buy. Today's metric, the value creation bridge. When a private equity fund sells a company, it typically breaks down the total gain into 3 components: revenue growth, margin improvement and multiple expansion. In Versace's case, the entry valuation was roughly 1 billion euros and the exit was 1.83 billion euros. That is a gain of roughly 830 million euros on the enterprise. Revenue rose from 600 million to 686 million euros, a gain of 14%. If the valuation multiple had stayed constant, that alone accounts for roughly 140 million of the increase. The swing from a loss to profitability improved margins. This is harder to quantify precisely for Versace because the company was private and did not disclose full details, but moving from a minus 7.4 million to plus 15 million euros in net income changes the earnings base a buyer uses to calculate price. The rest, the largest share, came from multiple expansion. When Blackstone entered, the luxury sector traded at roughly 10 to 12 times EBITDA. By 2018, driven by Chinese demand and a global appetite for European heritage brands, comparable luxury transactions were closing at 15 to 20 times. Michael Kors paid up because Versace was growing and because the market was willing to pay more for growth. This is the honest truth about private equity returns. Value creation is real and important, but market conditions and multiple expansion often contribute as much or more than operational improvement. The best deals benefit from all three. Versace did. So here is the insight. On the steps of Casa Casuarina, a bullet ended a life and nearly ended a brand. For 17 years, Donatella and Santo held the Medusa together through sheer will. Then a fund with a plan, 5 levers, and a professional chief executive walked in and in 4.5 years doubled the value. Private equity is not magic, it is not alchemy, it is renovation at scale. Find a good asset in poor condition, apply capital management and strategy, and sell it when the work is done. That is the entire model, and Versace is its cleanest illustration. With this episode, we close Model 1 of Ask Carlo, 12 episodes, 12 deals. Buyouts, venture, growth equity, secondary buyouts, infrastructure credit, premiumization, retail access, and now value creation. The foundations are laid. Module 2 begins next Tuesday, and we shift from foundations to the strategies themselves. Deeper dives, bigger deals, new stories. Subscribe, share this with anyone who has ever worn a Versace piece and never wondered who actually owned the brand. And send your questions to the link in the description. Remember, this content is educational only, not investment advice. Always consult qualified professionals. Stay sharp. Ask Carlo.
Ask Carlo. Private equity simplified.